For most people, the next crisis will not look like a collapse. It will look like a delay, a policy response, a temporary restriction, a bank that says your money is still there. And by the time the public understands what was actually lost, the rules will already have changed. History doesn't record collapses the way people expect. They don't begin with panic. They begin with reassurance. Argentina, 2001. Cyprus, 2013. Lebanon, 2019. In each case, the public was told the system was stable, right up until access to their own money was quietly restricted. This video breaks down one specific mechanism, how financial systems don't just fail, they redefine access. We're going to walk through the exact sequence. What breaks first? Who changes the rules? Why most people stay calm too long? And why, historically, about 90% of people lose purchasing power, not because they made reckless decisions, but because they trusted the structure itself. This is not financial advice. This is historical pattern recognition, because once you see the mechanism clearly, you start to recognize it early. The collapse doesn't start with money disappearing. It starts with a mismatch, a slow structural imbalance between what the system promises and what it can actually deliver on demand. Banks promise liquidity, but they operate on illiquidity. Your deposits are not sitting in a vault. They've been lent out, rehypothecated, leveraged. This works, as long as not everyone asks for their money back at the same time. That's the first pressure point. Now introduce stress, economic slowdown, debt defaults, currency pressure, political instability. It doesn't matter which trigger appears first. The mechanism is consistent. Confidence begins to crack. At first, it's invisible. A few large withdrawals, institutional money moving quietly, foreign capital exiting faster than it's replaced. The public doesn't notice yet because the interface hasn't changed. ATMs still work. Apps still show balances. Statements still look normal. But inside the system, something critical has shifted. Liquidity is tightening. Banks start depending more heavily on central bank support. Short-term funding markets become fragile. Interbank trust begins to erode. Now comes the second phase, policy intervention. Officials step in to stabilize the system. They don't frame it as a restriction. They frame it as protection. Limits on withdrawals, delays on transfers, temporary banking holidays. The language is always calm. Precautionary measures, short-term stability tools, necessary adjustments. But mechanically, something irreversible has just happened. Access has been separated from ownership. You still own your money, but you no longer control when or how you can use it. That distinction is where most people get trapped, because psychologically, nothing feels broken yet. Balances are still visible. Accounts still exist. So the majority waits. They assume normal access will return. Historically, this is where the window closes, because while the public waits, the rules continue to evolve. Capital controls tighten. Withdrawal limits shrink further. International transfers become restricted or blocked. Currency conversion becomes regulated. And then comes the third phase, repricing. This is where real loss occurs. Not through disappearance, but through devaluation. Sometimes it's explicit. A currency peg breaks. An official exchange rate is changed overnight. Other times, it's indirect. Inflation accelerates. Import costs surge. Black market exchange rates diverge sharply from official ones. In Argentina, depositors were pacified. Dollar accounts were forcibly converted into local currency at a government-set rate. In Cyprus, large deposits were bailed in. A portion of account balances was simply seized to recapitalize banks. In Lebanon, depositors technically still had their money, but in practice, they were locked into withdrawals at deeply unfavorable exchange rates. Same structure, different country, same outcome. The key pattern is this. The system doesn't fail all at once. It fails in layers. First, confidence, then access, then value. And most people only react after the final layer is already in motion. Why? Because each step feels temporary. Each restriction feels reversible. Each announcement sounds controlled. There is no single moment where the average person says, "This is it. The system is broken." Instead, there's a series of small adjustments, each one individually tolerable, collectively irreversible. And during this entire sequence, one group moves early: institutions, insiders, those closest to the policy decisions. They don't wait for official confirmation. They watch liquidity. They watch capital flows. They watch policy language. And when those signals shift, they exit quietly, before restrictions tighten, before conversion rules change, before repricing accelerates. That's why the losses concentrate the way they do. Not because most people are careless, but because they are structurally last in line. They trust the visible system, while the real system is already being rewritten underneath them. Micro summary. The majority doesn't lose everything in a crisis because of panic. They lose it because access is delayed, rules are changed, and value is adjusted before they realize the game has shifted. If you study these patterns, you start hearing the same language before the damage is obvious. Temporary, targeted, stabilizing, necessary. That is why this channel exists. Not for panic, for pattern recognition. If you value serious, evidence-based breakdowns of financial failure, institutional behavior, and wealth survival under pressure, subscribe. Because in every crisis, the people who understand the mechanism early are usually the ones least surprised by the outcome. Would you like me to revise this section, or should I continue to the next one? Section 5. Winners and losers. In every financial collapse, the losses don't distribute evenly. They concentrate. And they follow a pattern that repeats with uncomfortable precision. Start with the losers. The first group is the static savers. People who did what they were told. They saved in the banking system, held cash equivalents, trusted that liquidity meant safety. On paper, they look responsible. In reality, they are the most exposed because their wealth is denominated in the system that's being adjusted. When access is restricted, they wait. When conversion rules change, they absorb it. When inflation accelerates, their purchasing power erodes quietly. They don't lose everything overnight. They lose it gradually, while believing they're still safe. Next group, the yield chasers. These are people who moved slightly out on the risk curve. Corporate bonds, high-yield funds, structured products that promised a little more return. In stable conditions, this looks rational. In crisis conditions, it becomes fragile because yield is often compensation for hidden risk. When liquidity tightens, these assets don't just decline, they become difficult to exit. Prices gap down, buyers disappear, redemptions get gated, and suddenly, what looked like a liquid investment behaves like a locked position. Then come the institutional dependents, pension funds, insurance products, retirement structures tied to long-duration assumptions. These systems rely on stability. They assume predictable returns, orderly markets, functional credit systems. But during collapse phases, those assumptions break. Liabilities remain fixed. Assets get repriced, and the gap has to be closed somehow. Historically, that burden often shifts back onto the participants. Reduced benefits, delayed payouts, policy changes that weren't visible until stress exposed them. Now the final and most overlooked group of losers, the patient majority. These are not reckless people. They are cautious. They wait for clarity. They trust official signals. And that's exactly why they lose. Because by the time clarity arrives, the system has already moved through its critical phases. They act last. They convert last. They adjust last. And in a repricing event, timing isn't just important, it's everything. Now shift to the winners. The first group is the early movers, not because they predicted the exact crisis, but because they recognized stress signals early. They didn't wait for confirmation. They responded to unusual policy language, liquidity tightening, capital flow shifts, and they repositioned before restrictions hardened. Not perfectly, but early enough. Second group, jurisdictional diversifiers, people or institutions who did not rely on a single system. They held assets across different legal frameworks, different currencies, different banking regimes. So when one system imposed controls, they still had access somewhere else. Access is survival, not just ownership. Third group, holders of hard assets. This doesn't mean speculation. It means assets that are not someone else's liability. Land, energy resources, certain commodities, in some historical cases, precious metals. These assets don't depend on financial intermediaries to retain value. They may fluctuate. They may become temporarily illiquid, but they are not subject to the same kind of rule changes as bank deposits or financial contracts. When currencies are repriced, hard assets often move with or ahead of that repricing, not always smoothly, but directionally, they preserve purchasing power better than paper claims. Fourth group, cash flow controllers, people who control productive assets, businesses with pricing power, Supply chain leverage. Access to real goods. In inflationary or restricted environments, control over production matters more than financial positioning because they can adjust, raise prices, shift sourcing, navigate around restrictions more flexibly than passive holders. Final group, information realists. These are not insiders, but they are not passive either. They pay attention to signals, not headlines. They don't assume institutions will prioritize them. They don't assume rules are fixed. And most importantly, they understand that in a crisis, nominal value and real value separate. A bank balance can stay the same, while what it buys collapses. A retirement account can remain intact, while its future purchasing power erodes. Micro summary. The losers are those who trust stability too long. The winners are those who recognize when stability becomes conditional, not guaranteed. Conditional. And that distinction is where most outcomes are decided. Now bring this mechanism into a modern American frame, not as a prediction, as a comparison of structure. The United States does not resemble Argentina or Lebanon on the surface. It has deep capital markets, global reserve currency status, institutional scale. But the mechanics underneath are not as different as people assume. Start with the same foundation, a system built on confidence and leveraged promises. U.S. banks still operate on fractional reserves. Deposits are still lent out, invested, and exposed to market conditions. That hasn't changed. What has changed is the scale. Debt levels, public and private, are historically high. The system depends on continuous liquidity, and that liquidity is increasingly policy-driven. When stress appears, the response is not liquidation, it's intervention. We saw this in 2008, we saw it again in 2020, and more subtly, in regional bank stress events after that. The pattern holds. When stability is threatened, rules become flexible, facilities are created, backstops are expanded, definitions of safe collateral evolve. It doesn't feel like restriction, it feels like support. But the mechanism is the same one we've already examined. The system is being stabilized forward. Now consider access. In the US, access has not been broadly restricted, but small previews have appeared. Daily withdrawal limits, transfer delays, account freezes tied to compliance flags. Individually, these look minor, but structurally, they demonstrate something important. Access is conditional, not absolute. Now layer in inflation. Over the past few years, purchasing power erosion has become visible again, not hyperinflation, but persistent enough to matter. Food, energy, housing, insurance, the categories that matter most have moved the fastest. And here's where the mechanism becomes relevant. Because even without formal capital controls, real value can still be adjusted quietly through currency dilution, through negative real rates, through policy choices that prioritize system stability over individual purchasing power. No announcement required, no restriction notice, just gradual repricing. And most people respond the same way they always have. They wait. They assume normalization. They trust that institutions will restore equilibrium. And historically, sometimes they do. But sometimes, the new equilibrium is simply lower. Lower purchasing power, higher baseline costs, more dependence on policy support. No collapse headline, just a shift. Micro summary. The U.S. doesn't need a visible banking lockout to produce the same outcome. If purchasing power declines, while access remains technically intact, the mechanism has already partially played out. Different form, same structure. So what actually improves survival odds in a system like this? Not panic, not extreme predictions. Preparation. Historically, resilience comes from reducing dependency on any single point of failure. That means understanding three categories: access, purchasing power, and adaptability. First, access. Maintain enough liquidity to function through short-term disruption, not just in one institution, not just in one format. Because in real crises, the first problem is often not total loss, it's delayed access. Second, purchasing power. Study what your wealth is actually tied to. Ask a harder question. If the unit stays the same, but buys less every year, am I really protected? Historically, people survived better when part of their position was linked to real-world utility. Productive assets, essential goods, hard assets with enduring demand. Third, adaptability. The people who hold up best are usually the ones who can pivot. Multiple income streams, low fixed obligations, geographic flexibility, practical skills, strong local networks. Because once systems become unstable, optionality becomes a form of wealth. Micro summary. Do not prepare for a movie-style collapse. Prepare for restricted access, slower institutions, higher costs, and rules that change faster than public expectations. That is how most modern crises actually arrive. Most people think collapse is an event, a day, a headline, a moment you can point to. History suggests something quieter, a series of adjustments, each one reasonable, each one temporary, each one easier to accept than resist, until the outcome is locked in. And by then, there's nothing dramatic left to react to, just a new set of rules, a new definition of access, a new baseline of purchasing power, and a realization that the system didn't fail overnight. It changed, while most people were still waiting. That's the pattern. Not guaranteed, but familiar and visible to those willing to study it early. If you're here, you're not looking for comfort. You're looking for clarity. Subscribe if you want to keep building that clarity, one mechanism at a time, because in a world where the rules can change quietly, understanding the pattern is not optional. It's survival.